Listen to me very carefully, because right now, at this exact moment, you are losing money and you don't even realize it. That's it. Every single dollar sitting in your savings account is becoming worth less and less with each passing second. And the financial institutions you trust are lying to you about safety while they systematically rob you blind. Cash is trash. I don't care what your grandmother told you about saving for a rainy day. I don't care what your bank tells you about the security of FDIC insurance. And I especially don't care about your feelings on this topic. The numbers don't lie. And the numbers say that if you are hoarding cash in traditional savings accounts right now, you are actively choosing to be poor. Inflation is a silent thief that is stealing your purchasing power while you sleep. And it's not the 3% the government tells you it is. It's much, much worse. Your cash is being destroyed. Your future is being stolen. And you're sitting there thinking you're being financially responsible by saving money. You're not saving anything. You're losing everything. In the next 25 minutes, I'm going to prove to you mathematically why cash is destroying your wealth. And more importantly, I'm going to give you the exact strategy that wealthy people use to protect and multiply their money while inflation ravages everyone else. If you can't handle the truth, leave now, because I'm about to shatter everything you think you know about money. Before I break down the mathematics of your financial destruction, you need to subscribe to this channel immediately. And I'm not suggesting it, I'm demanding it. The information I'm about to give you is worth thousands of dollars. The kind of wealth-building intelligence that financial advisors charge massive fees to access, and you're getting it completely free, right here, right now. But if you're not subscribed, you're telling me you're not serious about your money. You're just a tourist watching financial content for entertainment, while your wealth evaporates. Winners subscribe because they understand value. Losers scroll past and stay broke forever. Hit that subscribe button and ring the notification bell, because I release this kind of combat level financial strategy regularly. And every video you miss is money you're leaving on the table. That could change your entire financial future. Now let me destroy your worldview about saving money and show you the brutal reality of inflation that nobody wants to talk about, especially not the financial institutions profiting from your ignorance. The government tells you that inflation is running at around 3 to 4% annually, and they calculate this using the Consumer Price Index, which is a manipulated joke that systematically understates real inflation by changing the basket of goods using hedonic adjustments and substitution effects that have nothing to do with your actual cost of living. The real inflation rate, the one you experience when you buy groceries, pay rent, fill up your gas tank, or pay for health care and education, is much closer to 7 to 10% annually. And in some categories, it's even higher. Let me give you the mathematics that will haunt you forever. If you had $100,000 in cash in the year 2000, and you kept it in a savings account earning essentially nothing, that same $100,000 today has the purchasing power of approximately $45,000. You lost 55% of your wealth by doing absolutely nothing except being safe with your money. Half your money vanished into thin air because of inflation, and your bank account balance still says $100,000. So you think you're fine? You're not fine, you're broke, and you don't even know it. Let me make this even more visceral and personal. In 2000, the median home price in America was about $165,000. Today, it's over $400,000. Your $100,000 in 2000 could have been a down payment on multiple properties. Today, it can barely cover a down payment on one overpriced house in most markets. In 2000, a gallon of gas cost $1.50. Today, it's over $3 in most places. Your grocery bill has doubled or tripled for the same items. College tuition has increased by over 200%. Healthcare costs have exploded. But your cash sitting in the bank earning 0.5% interest, it's just sitting there dying slowly while the bank tells you it's safe. The bank is lying to you. And I'm going to show you why they're doing it and how they're profiting from your fear. Let's talk about the cash parking fallacy and where your money goes to die, because this is where most Americans are committing financial suicide without realizing it. The average savings account in America right now pays approximately 0.5% annual interest. And some of the big national banks are even worse, paying 0.01%, which is essentially nothing. Meanwhile, real inflation is running at 7 to 10%, which means you're losing 6 to 10% of your purchasing power every single year. That's not safe. That's guaranteed destruction. Let me show you the bank's business model so you understand who is really benefiting from your safe savings account. You deposit $50,000 into your savings account, and the bank pays you 0.5% interest, which is $250 per year. The bank then takes your $50,000 and lends it out to other people at 6 to 8% interest for mortgages, car loans, and credit cards, earning $3,000 to $4,000 per year on your money. They're making 12 to 16 times more on your money than they're paying you, and you think you're being smart by keeping your money safe with them. You're not their customer, you're their product. You're the sucker providing them with cheap capital so they can make real money while you get crumbs. Now let's talk about the emergency fund myth, because this is where the financial advice industry has completely brainwashed you into thinking you need 6 months to 12 months of expenses sitting in cash doing nothing. Here's the truth. You need 3 to 6 months of expenses in liquid, accessible funds for emergencies. And that's it. Not 12 months, not 2 years, 3 to 6 months maximum. And even that should be in high-yield savings accounts or money market funds earning at least 4 to 5% right now, not sitting in your regular bank account, earning nothing. Anything beyond that emergency fund is not safety, it's self-sabotage. Every dollar above your emergency fund that's sitting in cash is a dollar that's not working for you, not compounding, not building wealth, and not protecting you from inflation. Let me give you a real example that will make this crystal clear. You have $50,000 sitting in a traditional savings account, earning 0. 5% annually over 10 years, assuming you never touch it. That $50,000 grows to $52,563. Congratulations, you made $2,500. But inflation at 7% annually means you need $98,358 to have the same purchasing power as your original $50,000. You lost $45,795 in purchasing power by being safe. Now let's look at what happens if you invested that same $50,000 in a simple S&P 500 index fund averaging 10% annually, which is a historical average. Over 10 years, your $50,000 becomes $129,687. That's $79,687 in gains, and even after accounting for inflation, you've grown your wealth significantly. The difference between the saver and the investor over 10 years is $77,124. That's the price of your fear, and it's making you poor. Now let me show you where winners actually put their money, because this is the asset allocation strategy that separates wealthy people from broke people. And it's not complicated. It's just different from what your parents taught you. Winners understand that money needs to work, and the only way money works is by being deployed into assets that appreciate faster than inflation and generate income. The foundation of wealth building for anyone who serious is index funds and exchange-traded funds, specifically those tracking the S&P 500, because this is the boring, unsexy, proven wealth-building machine that has created more millionaires than any other investment vehicle in history. The S&P 500 has averaged approximately 10% annual returns over the past century, including crashes, recessions, wars, and every economic disaster you can imagine. If you simply invest consistently in an S&P 500 index fund like VOO or SPY, and never touch it, you will build wealth. It's mathematical certainty. Wealthy people also invest in dividend-paying stocks and dividend ETFs because they understand that passive income is the key to financial freedom. Funds like BYM, SHD, or BIG pay you dividends quarterly just for owning them, and those dividends can be reinvested to accelerate your compound growth or used as income. This is how you create cash flow without selling your assets. For people who want real estate exposure without the headache of being a landlord, real estate investment trusts, or REITs, are the answer. And you can invest in them through funds like B&Q, which gives you exposure to thousands of properties and pays significant dividends. Then there's the actual safe money that people should be using for their short-term needs and conservative portion of their portfolio. Treasury inflation protect securities called TIPS and I-bonds, which are government-backed and actually adjust for inflation, meaning you don't lose purchasing power. These are real safety, not the fake safety of a savings account. Now, let me give you the exact portfolio allocation that will change your life if you actually implement it. For beginners or people within 10 years of retirement, use the classic 60-40 portfolio, 60% in stock index funds like VOA and 40% in bond funds like BND or Treasury securities. This gives you growth with some stability. For aggressive younger investors who have time on their side, go 80 to 90% stocks with index funds and dividend ETFs and 10 to 20% in bonds or REITs. The specific tickers you need to know are VOO or VTI. For V, total stock market exposure, SHD for dividend growth, BNQ for real estate, and BND for bonds. These four funds can build generational wealth if you consistently invest in them. Let me prove it to you with mathematics. $50,000 invested in a portfolio averaging 10% annually becomes $129,687 in 10 years. In 20 years, it becomes $336,375. In 30 years, it becomes $872,470. That's from a single $50,000 investment. Now imagine if you're adding $500 every single month to that investment. In 30 years, you have over $1,177,000. This is not a get-rich-quick scheme. This is the boring, proven path to wealth that requires discipline and patience. And most people won't do it because they're addicted to the false comfort of cash. Now let me address the only legitimate reason to hold cash. Because I'm not completely insane and I understand that life has emergencies and you need liquidity for unexpected situations. You absolutely should have an emergency fund, and here's exactly how much you need and where to put it. Calculate your monthly essential expenses, the bare minimum you need to survive, including rent or mortgage, utilities, food, insurance, and basic transportation. Multiply that number by 3 to 6 months depending on your job stability and family situation, and that's your emergency fund target. If you're a single person with a stable job, 3 months is fine. If you have a family, variable income, or work in an unstable industry, go for 6 months. That emergency fund should not be sitting in your regular checking account earning nothing. And it definitely shouldn't be in a traditional savings account at a big bank earning 0.01%. You need to park it in high-yield savings accounts or money market funds that are currently paying 4 to 5% annually. Right now, as of this recording, accounts like Marcus by Goldman Sachs, Ally Bank, American Express, Personal Savings, and Capra 1360 are paying over 4% on savings accounts with no minimums and full FDIC insurance. That's where your emergency fund lives, earning something while remaining completely accessible. Here's the tiered strategy that sophisticated people use. Keep 1 month of expenses in your regular checking account for immediate access and monthly bills. Keep 3 to 5 months in a high-yield savings account for true emergencies that you can access within 1 business day. If you want to be extra prepared, keep another 3 to 6 months in a brokerage account in a money market fund or short-term treasury fund that pays even more but might take 2 to 3 days to transfer back to your checking account. This gives you maximum return while maintaining liquidity for real emergencies. Now here's the critical mistake that most people make. They build an emergency fund and then they just keep adding to it indefinitely, letting cash pile up to 12 months, 18 months, 2 years of expenses, thinking they're being responsible, when in reality, they're destroying their wealth. Once your emergency fund is complete, every single additional dollar needs to be deployed into investments immediately. Your emergency fund is not an investment, it's insurance, and you don't buy more insurance than you need. Set up automatic investments so that every paycheck, after you cover your expenses and emergency fund contribution if needed, the excess goes directly into your investment accounts before you can spend it on garbage. This is the pay yourself first principle that every wealthy person follows. And it's the only way to guarantee wealth accumulation because it removes emotion and discipline from the equation. The system forces you to invest, and the investment forces you to be wealthy. Now let me give you the exact action plan to convert your trash cash into wealth-building assets in the next 30 days. Because knowing what to do is worthless if you don't actually execute. And this is where 95% of people who watch this video will fail. Week 1 is audit and calculation week. You're going to log into every single bank account you have, add up all your cash holdings, and calculate your emergency fund requirement based on your essential monthly expenses, times 3 to 6 months. If you have more cash than your emergency fund requirement, that excess is getting deployed into investments immediately. Write down the exact dollar amount that needs to be invested. Week 2 is account setup week. You're going to open a brokerage account with a low-cost platform like Vanguard, Fidelity, or Charles Schwab, which take about 15 minutes to set up online and have 0 account minimums. You're also going to open a high-yield savings account if you don't already have one, and move your emergency fund there from your traditional bank. This is also the week you're going to research and decide on your asset allocation based on your age and risk tolerance using the portfolios I outlined earlier. Week 3 is deployment week, and this is where you're going to use dollar cost averaging to move your excess cash into your chosen investments. Don't try to time the market. Don't wait for a crash. Don't look for the perfect entry point. You're going to divide your investable cash by 4 and invest 25% of it per week over 4 weeks. This smooths out any short-term volatility and removes the emotional paralysis of investing a lump sum. Week 4 is automation week, where you set up automatic monthly transfers from your checking account to your investment account, forcing yourself to invest before you can spend. Decide on an amount that's aggressive but sustainable, whether that's $500 per month or $2,000 per month, and automate it so it happens on payday before you see the money. This is the system that guarantees wealth building because it runs on autopilot, regardless of your motivation or discipline on any given day. Now let me address the psychological barrier that's going to try to stop you from doing this, because I know exactly what's happening in your head right now. You're scared. You're thinking about market crashes and losing money, and what if there's a recession, and what if you need that cash? Here's what you need to understand. The risk of doing nothing is far greater than the risk of investing. Cash is guaranteed to lose value to inflation. Investments have temporary volatility, but long-term growth. Every single person who has consistently invested in index funds over any 20-year period in history has made money, including people who started investing right before the Great Depression or right before the 2008 financial crisis. Time in the market beats timing the market, always. Risk management comes from diversification and time horizon, not from hiding in cash. If you're investing money you won't need for 5 to 10 years minimum, market crashes are irrelevant because you have time to recover and benefit from the subsequent growth. Finally, make sure you're maximizing tax-advantaged accounts first. If your employer offers a 401 kilobits match, that's free money and you're investing enough to get the full match. before anything else. Then max out your Roth IRA if you're eligible, which is $6,500 per year, or $7,000 if you're over 50. These accounts let your money grow tax-free or tax-deferred, which dramatically accelerates your wealth building. Only after you've maxed out tax advantage space should you invest in taxable brokerage accounts. We've reached the end of this financial combat session, and now you have a decision to make that will determine whether you're wealthy or broke 10 years from now. You can either be a winner who takes this information, implements it in the next 30 days exactly as I've outlined, and builds real wealth while everyone else loses to inflation. Or you can be a loser who watches this video, feels temporarily motivated, and then goes right back to hoarding cash and savings accounts while your purchasing power evaporates. There's no middle ground here. Cash is trash. The numbers don't lie. Every single day you leave money sitting in low interest accounts is a day you're choosing to be poor. I showed you the mathematics. $50,000 in a savings account over 30 years becomes functionally worthless after inflation. That same $50,000 invested becomes over $800,000. That's not an opinion. That's compound interest and historical returns. 10 years from now, you will either look back at this moment and thank yourself for taking action, or you will look back with regret, wondering why you didn't listen when someone told you the truth. The choice is binary and it's yours. Are you going to be an investor who builds wealth, or are you going to be a victim who loses to inflation? Are you going to trust proven mathematical strategies, or are you going to trust your fear and the lies banks tell you about safety? Subscribe to this channel right now if you haven't already, because I'm going to continue giving you the aggressive, no-nonsense financial strategies that separate winners from losers. Join the community of people who actually want to be wealthy, not just comfortable in their ignorance. Stop being a victim of financial institutions and start being a victor who controls their own financial destiny. Now get out there and execute everything I just told you, because talking about wealth and building wealth are completely different things, and only action creates results.